ESG, in my view, should not be a dictated mandate. It should be something that's ingrained in the corporate culture, starting from the early analysis of a project. And look, as a credit analyst for 35 years, we're taught to evaluate environmental liabilities, social responsible investing, and corporate governance. So it's ingrained in us as analysts to start with. So I think ESG should not be dictated. ESG should be part of the core focus of any investment decision. We don't invest in funds really outright. We provide non-syndicated direct debt and equity investments, as I mentioned, anywhere from 150 million to well over $1 billion. But I would say whether you have an investment in a company or directly into a fund as an LP, management is most important, nothing else. So that goes to corporate governance. That goes in terms of the ability of management to invest through or manage through investment cycles. And then obviously their ability to execute. So management is going to be top priority in anything we look at when we're looking at investments pre-pandemic or post-pandemic. I think it's very important from us as a family. We're looking at people that are custodians of our multi-generational wealth. So we want to be able to entrust our capital with management that will be good custodials of our capital, and obviously be able to execute on a plan to provide us with the returns that we would expect for the risks that are being taken. As I mentioned in your last question, picking the right management team is critical, whether you're an LP or whether we're doing direct investments. And that would be the case for anyone. Look, as a family office, we're very friendly, we're flexible, we're a passive investor. Thus, we always want to work with the companies that we invest in that can operate in terms of good times and bad. And we want to work with them should things get into trouble. We want to be that flexible. We want to extend payment schedules. We basically want to work with them. We're not looking to foreclose on assets or going through a prolonged restructuring process. Post-pandemic, I think the biggest change is our demand for management with long track records, as I mentioned, so to execute through business cycles. And also we're demanding a higher equity return on the equity we're providing. So pre-pandemic, I would have said we were looking for IRRs in the low teens. Now we're looking for IRRs on our equity capital, again, above 20%, which is not necessarily easy to find depending on the asset class. But we have a global mandate, so we're looking on and we're very asset class agnostic, so we're able to find those type of returns. Everybody, as part of Super Return Europe, we're all leaders in our respective industries. And I think we have a responsibility to include ESG in our corporate culture, and more importantly, diversity and inclusiveness, particularly after everything that's gone on over the past 12 to 18 months. And I think this needs to be ingrained in our personal as well as our professional lives. I think, as mentioned, as we've seen things over the course of the last 12 to 18 months in the US, we need to basically evaluate the companies that we're investing in, and then also our own companies, to making sure that diversity is included as part of us in terms of inclusiveness, in terms of social impact investing. My colleague Per Wimmer wrote a book called The Green Bubble. So we're not going to invest in everything just because it's green and it's socially responsible and has a good impact on the environment. We always have to make sure that the return is appropriate to the risk that we're taking. We're not paid to be philanthropists. So each of our families in our multi-billion-dollar multifamily office have that mandate. They want to be philanthropists. We're paid by getting a return for the risk that we're taking. So we want to be cognizant of that. But where we can, we obviously want to make sure, as part of our ethos, that we are good global citizens, socially responsible, and including ESG into our tool set, and also making sure in both our own company as well as the companies we invest in, inclusiveness, impact investing, and diversity is all part of that. I think I could spend the next 2 hours talking about that, but given our small time frame, I would say, look, Technology has been key during this pandemic to allow us as global citizens, right, to communicate in ways we've never imagined a decade ago and probably never imagined 6 months ago. Who would have thought people's parents and grandparents would be communicating on something called Zoom or team chats or something like that? But now it's a way of life. I sit in my office from 7 in the morning to sometimes 10, 11 o'clock at night on Zoom chats, Microsoft team chats, etc. So it's clearly changed the way we work, and I think that'll be the way we work for quite some time. Look, technology will continue to impact our lives and likely become more intrusive in our lives, I think, than ever before, but in good ways. You know, our cars today have more data on us than our own homes and our offices. I think this will change in the future as our homes, our offices, care homes for the elderly, hotels of the future will have more ways to monitor our health and our well-being. So I think life sciences, AI, clean tech, green tech, the digital economy will all become more and more important. And the companies in those sectors will benefit from it. And we will be looking for those companies in terms of our investment decisions. So we'll stick to our core. Our core, as I mentioned, real estate, asset heavy industries, but we'll be looking for those companies in technology, not as seed investors or venture capital investors, but ones that are more well established to probably put more investment dollars into those or a bigger portion of our investment spend.